We have all felt this. This is a very, very normal, natural feeling. Is you see someone who has something that you want. Even if you didn't want it before, you're like, I fucking want that now. So you start trying to tell yourself, no, I want this house, not the one coming after that I could get for 20% less. I want this one. And you start bidding. And then a third person starts bidding. And then next thing, you've got a bidding war. Common term. That's what they're always trying to get in these auctions, is they're trying to create a bidding war. And when it happens, that shows you the psychology of markets and of people within those markets. And by markets, it can be anything. Like I said, houses, crypto, stocks. Because humans are irrational when it comes to money. We FOMO into everything, basically. The excitement, of price getting bid up, it makes us assign value to the price or to the asset that wasn't there before. Think about it. Right now, good example, as I speak, 10th of January. Bitcoin's 42k and nobody wants to buy it. But 6 weeks ago, Bitcoin was at 60k and everybody was tripping over themselves to buy it. Because the chart looked good and the technicals were all pointing bullish and everyone was saying we're going to 70, 80, 90, 100. So you want to pay 18,000 more 6 weeks ago for the same asset, and now you don't want to buy it at all at 42 because you think it's going to go lower. Pure psychology, and it's painted through candlesticks. All right? They paint the chart to make you feel a certain way so that you make a decision that is against your best interests. If you see the screenshot, forgive the fact that it's kind of cut off. I had to take it from a tweet. That was as good as I could get it. But the fear and greed index, which is, some people like it, some don't. I think it's useful in confluence with other factors, but look at that. 40k at the start of 2021 versus 40k at the start of 2022. In 2021, we had extreme greed at 40k. 1 year later, we've got extreme fear. You can't see it there, but that's 10. Perfect, a literal 180 in sentiment at the exact same price. You're going from plus 90 to fucking 10. All right, so same asset, same price, 1 year apart. It's funny, isn't it? Rule 22. Whales must engineer liquidity. All right, so here's a breakdown of exactly how a whale does business and why. Because, you guys won't really understand. I assume you won't understand it because you've not been in the position before. But trading for whales is not about buying the bottom and selling the top, right? For whales and companies essentially that do this for a living over long periods of time, and no retail trader has any type of long-term mindset with crypto, which makes it even easier for the whales. They are looking for a return on investment, right? If you look at this chart example here of a random alt I picked, you can see on the bottom left accumulation. This is a months-long period when whales are buying, retailer either capitulating and selling, or they're getting chopped up because it's obviously a very choppy range. It doesn't trend. Whales don't care. They've got all the time in the world. They've got deep pockets. They buy it all up here because they know that when they suck enough of that liquidity up, what's going to happen? They're going to be able to pump price. And so it goes through a very predictable process in crypto. You go from that accumulation into what you call a test pump, which is just essentially the first spike and then a drop off. That's to get people interested. It serves two purposes. It spikes the chart up so that it probably goes on the top gainers of the day on all the websites, so that gets people interested. They add it to their watch list, blah, blah, blah. Typically, here is where retail FOMO in, and then, of course, in the bear trap, they sell. All right? Or it spikes here and they do nothing. It comes down here and they forget about it. They say, I was right. Either way, they either buy here and sell here, or they do nothing here, and they do nothing here. Then we get the big move up, and then suddenly they're starting to think, now. So even though it's completely irrational, now they're starting to think it's a good price. So if they bought here and sold here, they probably FOMO back in here. Or they're angry and they say, oh, this one's going to fail as well, and then they FOMO back in here. But regardless, the whale is taking this as high as possible, not to trap retail, not indirectly, or not directly, sorry, but indirectly. The reason a whale is pumping it is that you want to pump as far away from here as possible, as high as possible, to anchor price for retail. So even though this only spent one day, one very small part of this one day at this high price, all that matters is the all-time high has been printed. When you print an all-time high, in this case it's 0.035 roughly, so about 3.5 cents. As soon as you print that, that becomes the target, that becomes the metric by which all data in future is measured. And that's all that matters. Because you've now printed price up there. So when it drops down to here, what does that make it? That makes it a good buy, because that's about 60, that's about 61.8, the Fibonacci golden ratio. Drops all the way down. People buy it because they think, well, buy the dip. So they buy it, and of course, maybe that was a good trade, but they probably bought it thinking it was going to new highs. But what is that actually doing? That is liquidity engineering. Because the whale who bought here, yes, they sold some up here, but not really. The tops are very illiquid. You'll probably, hopefully some of you'll understand this when you're trading bigger size in future. The tops of these altcoins are super illiquid. You don't actually get much sold. That's why it's such a quick spike up and spike down. There's not a lot to sustain it. But what the real move is for is that when it comes down here, there are willing buyers, and the willing buyers are at, this green line from the bottom is 210%. So this line up here is probably about 400%. That's 400% return on investment for the whale. Not to mention they sold some here. Then they're selling some at 400%. Then it goes up here and they're selling some at probably 600%. Then they're selling, again, distribution the whole way down. Then it reaches a floor, which is significantly higher than the previous accumulation, which equals a well-executed pump and guaranteed exit liquidity. So now this entire chop here and this capitulation down to here and then this eventual reaccumulation, this is all free money. Amazing profit for the whales. So you see that if you accumulate enough of the supply and you drive price up enough, even if it's only for 1 minute and it reaches a peak, you have guaranteed yourself exit liquidity. Why? Because when it drops 60, 70, 80%, people are conditioned to buy it. So retail will say, well, that's a good deal. It's down 80%, I'll buy it. But obviously, if you go high enough, that 80% still keeps you way above your cost basis, and you can just sell forever in profit. So that's it. That's exactly how liquidity is engineered. Create a new floor for price, and you'll always be able to sell in a profit. So you can take this and benefit from it by looking for coins that are accumulating. Pretty easy to spot. The thing is, most people don't have the patience. Just look at it over a period of months. So ideally what you want to do is look through them all and find the ones that have already been accumulating for 2-3 months, and that are maybe something that's you just subtly see it start. All right, but this is starting to trend up, and zoom out. Like if you had saw this spike and then dropped, and then you saw it coming up again, you could have even got in here. Hindsight obviously shows you all that happened after, but keep in mind that especially these alts, the same patterns repeat over and over and over. They don't look identical, but this is extremely common. Everything I've marked out here is pretty much universal. So just look for that in the chart. You can even just wait until you find price anchoring. Let it capitulate the whole way down. And when it's doing this truly low volatility bleed, see this kind of stuff here, this choppy, quite long candles, that's still distribution. Because that means people are still trying to buy it, thinking it's a good price, spikes up for the last little bit, then it gets to here, and this is the part. When you get this low, like no volatility, drops down. And even this is super easy. When it came up here, still on low volatility, but whenever it started coming up there, that's the bottom's in, and you're back into accumulation. Now you can start buying, and you know that you won't have to wait as long for price to start moving up. So that's liquidity engineering. Take that lesson, apply it, use it, understand how whales have to work. Whales are throwing such big money around that they have to do this kind of stuff to guarantee liquidity. So when we say think like a whale, think like, what would I do if I had to put an 8-figure, 9-figure position on? If I wanted to buy a 10 million market cap, 20 million market cap coin, and I wanted to buy 60% of the supply up off the market, how would I do it? All right, and game that out in your head, and that will really help you as a trader from a psychological perspective. So, to finish, we've covered all aspects of psychology from a high level right down to a very granular, and finished it up with thinking like a whale, which is the most important way to think for you to flip on its head and trade opposite to it, trade opposite to the masses. And next we're going to move into module 2. So that'll be coming up very soon. Thanks for watching. Finish it here.